October 29th, 1929. Wall Street, New York. The scene isn't just busy. It's pure, undiluted panic. Men in suits, their faces pale, are shouting over each other. Pieces of paper stock certificates are fluttering to the ground, ignored. It's a crowd, but it's not a group. It's 1,000 individuals, all trying to do the exact same thing at the exact same time. Get out. We look back and see the charts, the numbers, the economic data. We think the market crashed because of math, because of overvaluation and bad policy. But what if I told you it wasn't the numbers that crashed the market? What if the real culprit, the invisible force that brought the whole system to its knees, was something much more primal, much more human? What if it was fear itself? To understand the panic, you have to understand the party that came before. The 1920s, the Roaring Twenties. The First World War was over, and a new modern America was bursting to life. Radios, cars, jazz. There was a sense of limitless optimism. And nowhere was that optimism more concentrated than on the stock market. Stocks weren't just going up. They were skyrocketing. It seemed like a one-way back to Easy Street. This wasn't just a market for wealthy bankers anymore. This was a national mania. Ordinary people, your butcher, your baker, your mechanic, were pouring their life savings into stocks. They were reading stock tips in barbershops and buying shares based on a rumor from a neighbor. But how could a regular person afford to bet big? The answer was buying on margin. Think of it like this. You want to buy a $1,000 stock, but you only have $100. Your broker would loan you the other $900. You'd only put down 10%. If the stock went up to $1,100, you could sell it, pay back the $900 loan, and walk away with $200. You just doubled your money with only a tiny investment. It was magical. And for years, it worked. The stock kept going up. Everyone was doing it. The social proof was overwhelming. The greed for easy money drowned out the quiet, sensible voice that should have been asking, but what happens if it goes down? Because if that $1,000 stock dropped to $900, your broker would issue a margin call. They'd demand you immediately pay back some of the loan to cover the loss. If you didn't have the cash, and most people didn't, the broker would sell your stock at a loss right then and there. The entire booming market of the late 1920s was built on a towering, shaky foundation of debt. It was a party, and everyone was invited, but the bill was going to come due all at once. And then the bill arrived. The market had started to get shaky in September of 1929. It was like a Jenga tower that had gotten too high, wobbling slightly. Then, on Thursday, October 24th, Black Thursday, the wobble became a tremor. A few big, smart investors, sensing the peak, started quietly selling. They got out early. But in a crowd this jittery, you can't do anything quietly. The news spread. A whisper, the big guys are selling. A rumor, the market is crashing. And that was all it took. The spark had been lit. Fear is contagious. It moves through a crowd faster than any fact, any piece of good news. It's a biological signal. Your brain sees panic in someone else's eyes, and your own fight or flight response kicks in. On the floor of the stock exchange, that fear became a stampede. It wasn't a rational decision anymore. It was a primal instinct. Get out, now. Brokers, facing massive margin calls from their clients, were forced to sell. Thousands of them, all at once. And when everyone is trying to sell, and no one wants to buy, the price doesn't just fall, it collapses. The following Tuesday, October 29th, Black Tuesday, was the full-blown avalanche. A record-shattering 16 million shares were sold. The ticker tape ran hours behind, so people were selling blindly, not even knowing how much they had already lost. They just knew they had to get out. The crowd was now a mob, and they were all trying to squeeze through a single, narrow exit. But the crash didn't end on Wall Street. This is where the real domino effect began. The fear jumped from the stock market to the banks. People who lost their savings in the market rushed to pull their actual cash out of their bank accounts. But the banks had also invested in the market, and they had loaned money for all that margin buying. They didn't have enough cash on hand, so banks started failing, thousands of them. When the banks failed, businesses that relied on loans couldn't pay their workers. Unemployment soared. The fear that started in a few investors' hearts had now infected the entire American economy, creating the Great Depression. So, let's break down the psychology. Why did a dip turn into a crash? Why did a sell-off turn into a panic? It comes down to three powerful mental glitches. First, herd mentality. We are hardwired to look to the group for safety. If the herd is running, there must be a predator, right? Your individual reasoning shuts down. On the trading floor in 1929, no one stopped to ask, is this company actually still valuable? They just saw everyone else selling and thought, they must know something I don't. I must sell too. It's safety in numbers, even when the numbers are running off a cliff. Second, and this is a big one, loss aversion. This is a well-documented psychological principle. The pain of losing $100 is about twice as powerful as the pleasure of gaining $100. As those stock prices started to fall, the pain of watching their life savings evaporate was unbearable for people. That fear of losing even more became a more powerful motivator than the hope of a rebound. So, they sold not necessarily because they believed the company was worthless, but to stop the excruciating pain of watching the numbers go down. They were cutting their losses to end the psychological torture. Finally, trust evaporates. The entire stock market, the entire banking system, is built on one fragile thing: trust. Trust that your money is safe in the bank. Trust that a stock certificate represents real value. Trust that the other players are acting in good faith. In October 1929, that trust shattered instantly. People didn't trust the brokers. They didn't trust the banks, and they didn't trust the information they were getting. When trust disappears, the system doesn't just slow down, it breaks, it freezes. And that's exactly what happened. The story of 1929 isn't just a history lesson, it's a blueprint. You can see its fingerprints everywhere. In the 2008 housing crisis, it was the same contagious fear first in overvalued mortgage bonds than in the entire banking system. In the 2022 crypto crash, it was the same margin calls and herd mentality, just with digital assets. Even in the frenzy of meme stocks, you see the same dynamic. A crowd moving as one, driven by emotion rather than fundamentals. The lesson is as true today as it was a century ago. Markets do and move only on numbers. They are living, breathing systems powered by the two most powerful human emotions, greed and fear. And when the switch flips, when greed turns to fear, we are reminded of a brutal, timeless truth. Fear will always, always outrun reason.